Welcome to vTalkInsight, Market Drivers Daily for March 9th, 2026. The oil shock centered on the Strait of Hormuz has moved from headline risk to the key macro force, shaking energy markets, volatility, and rate expectations all at once. Let's unpack how this energy crisis is reshaping the cross-asset landscape today. The core story today is that the world has shifted from an energy scare to a full-blown energy crisis centered on the Middle East. Oil has moved from the high 80s and low 90s earlier in the week to consistently trading above $100 a barrel, with repeated spikes toward $120 as the Strait of Hormuz remains effectively shut. Roughly a fifth of global oil and liquefied natural gas normally moves through that choke point, and tanker traffic has collapsed under the weight of war risk, spiking insurance costs, and drone and missile threats. On the physical side, supply losses are now significantly larger than in the early stages of the 2022 Russia shock. Middle East disruptions have taken around 6 million barrels a day offline, more than double some initial estimates from that earlier crisis, while at least 20% of internationally traded gas, largely from Qatar and the UAE, is shut in. Major Gulf producers such as Saudi Arabia, Kuwait, the UAE, and Iraq are cutting output because storage is near capacity and logistics are blocked, pointing to prolonged tightness even if hostilities ease. Policymakers are scrambling to build a bridge over this disruption, but the supports look uneven. G7 finance ministers are discussing a strategic oil reserve release of roughly 300 to 400 million barrels, larger than the Ukraine-era move, and global inventories above 8 billion barrels could, in theory, cover more than 400 days of lost Hormuz shipments. Yet the U.S. Strategic Petroleum Reserve is at its lowest level in decades, covering only about 3 weeks of domestic use, and past experience suggests such releases mainly slow rather than reverse price spikes. Despite the scale of the disruption, market pricing still leans toward a short-lived shock. Oil futures curves are in steep backwardation, with spot crude up 50 to 60% in recent weeks, while contract for delivery in the autumn are only up in the mid-teens, signaling expectations that prices fall back toward $80 once transit normalizes. Some analysts even emphasize rising U.S., Canadian, and Brazilian production and ample global inventories as buffers, arguing that non-OPEC supply and potential output from places like Venezuela will eventually cap the upside. The macro channel, however, is turning more threatening as the shock persists. Estimates suggest sustained prices in the $100 to $120 range could shave more than a full percentage point from global growth and significantly lift inflation, feeding stagflation fears. Consensus still assumes around 14% annual earnings growth for 2026 and 2027 and roughly 2.5% GDP growth. But higher fuel costs are already pressuring travel, transport, and consumer-facing sectors, while strategists now put the probability of a U.S. market meltdown at about 35%. The biggest near-term pressure point is the consumer. U.S. gasoline prices have risen 15 to 16% and could soon breach $4 a gallon as global product shortages, especially in Asia, feed through to the pump, hitting households that are already more stretched than during the last energy spike. Energy and defense stocks are outperforming as Brent and WTI stay above 100, while airlines, cruise lines, gig economy names, and discount retailers face shrinking margins and softer demand as fuel and freight costs rise. Overlaying all of this is an adverse geopolitical backdrop that argues for a more durable risk premium in energy. Iran's new hardline leadership, closely aligned with the Revolutionary Guard, signals continuity and defiance toward the West, limited appetite for compromise on nuclear issues, and ongoing proxy activity that keeps shipping through Hormuz and the Red Sea at risk. Even if hostilities pause, sustained damage to infrastructure, elevated insurance, and talk of U.S. maritime reinsurance all point to a structurally higher cost of moving energy out of the Gulf. Looking ahead, the key variables are duration and damage. Markets are watching closely for the first successful transit of non-Iranian tankers through the Strait of Hormuz under military escort, Any firm G7 decision on reserve releases, and signals from Tehran about whether this leadership will double down on nuclear ambitions. If shipping lanes reopen quickly and facilities avoid lasting damage, the current backwardation could prove accurate. If not, today's structural risk premium in crude and natural gas may still be underpriced, with broader implications for inflation, growth, and asset pricing. The energy shock is feeding directly into a more volatile, but not yet panicked, risk environment. Equity volatility has jumped, with the VIX recently spiking above 31 and swinging more than 30% intraday, while oil has seen some of the largest single-day percentage moves on record as options shorts scrambled to cover. We have witnessed crude swing nearly $40 within a session, and spot trading volumes have surged from roughly 300,000 to close to 1 million contracts a day, amplifying intraday noise. Headline equity indices still mask a lot of underlying stress. Global benchmarks are off, with S&P futures down close to 1% and Euro Stoxx futures down around 1.5%. But Europe is already almost 10% below February highs, and airlines have slipped more than 20% into a bear market. Financials have underperformed sharply, while large-cap technology and quality growth continue to show relative resilience, reinforcing the sense of a rotation rather than a broad capitulation. Positioning data suggest market fragility if the shock deepens. Hedge funds lifted short positions in equity ETFs by more than 8% last week. Retail allocations to U.S. equities remain near record highs, and there is heavy crowding in S&P index funds and private equity. That mix raises the risk that any further deterioration in liquidity or private market funding could trigger forced selling in public markets, turning today's controlled volatility into a more disorderly unwind. At the same time, classic signs of a full washout are not yet in place. Technical breadth is only moderately weak. There is no evidence of indiscriminate selling across sectors, and put-call ratios and the share of stocks trading below their 50-day averages are being monitored but have not yet flashed a clear capitulation signal. Despite the oil shock and escalation in Iran, U.S. indices have repeatedly recovered from intraday drops, and valuations and earnings expectations have not materially reset. This leaves a split narrative around volatility. One camp views the current swings as the symptom of a high-risk but intact bull market, arguing that underlying earnings, AI-driven capex, and prior de-risking in quality U.S. names still support risk assets once the commodity panic eases. The opposing viewpoints to rising estimates of a U.S. market meltdown, now placed around 35% probability, and to equity markets that have only modestly adjusted despite oil trading well above $100. The trigger for a true volatility regime shift likely lies in duration and policy reaction. If oil stays elevated for several months, forcing earnings downgrades and a more hawkish central bank stance, then today's controlled sell-offs could morph into a broader risk-off move. For now, markets are watching for signs such as a sustained VIX break higher, a turn toward indiscriminate selling across sectors, and heavier outflows from equities into ultra-short treasuries and cash as signals that volatility has moved from episodic to structural. The third major strand today is how the energy shock is rewiring expectations for the monetary tightening cycle, especially in Europe and the UK. Over the past few sessions, markets have swung from debating rate cuts to pricing renewed hikes as oil above $100 and natural gas spikes revive inflation fears. Global bond yields are backing up sharply, contributing to tighter financial conditions just as growth headwinds from higher energy costs start to build. Europe sits at the sharp end of this repricing. Short-end yields in Euro area and UK government bonds have jumped as much as 20 basis points intraday, with some two-year gilts now above 4% and front-end curves trading through central bank policy rates. Markets are now fully pricing 2 European central bank rate hikes over the coming years and assigning more than a 50% probability to a Bank of England hike, a stark reversal from the cuts narrative that dominated just days ago. The Federal Reserve picture is more nuanced but moving in the same direction. Market-implied probabilities for near-term cuts have faded, with only around 1.5 cuts priced for this year, and some participants even flirting with the risk of a hike if inflation stays sticky. Recent U.S. labor data, including an unexpected payroll decline and unemployment ticking up to about 4.4%, complicate the picture, but energy-driven inflation has again become the dominant constraint on Fed flexibility. This shift reinforces a stagflation dilemma for central banks and investors alike. Rising oil and diesel prices are pushing up headline inflation and inflation expectations, while at the same time threatening consumer spending and corporate margins, particularly in energy-importing economies and lower-income U.S. households. Traditional safe havens such as government bonds and gold have offered less protection as yields rise and real rates move higher, leaving the U.S. dollar supported by higher Treasury yields and its status as an energy exporter as the main beneficiary. Policy divergence is becoming more pronounced, and there are growing questions about whether the bond market is now overshooting on the hawkish side in Europe and the UK. Some strategists argue that, relative to 2022, both regions are entering this shock with weaker growth and lower underlying inflation, which could limit how far the ECB and Bank of England can actually tighten. At the same time, there's a view that the Fed may ultimately deliver more easing than currently priced once the immediate energy shock fades and slower growth becomes harder to ignore. The transmission channel from these rate expectations back into the real economy is already visible. Long-end yields in the U.S. and Europe have moved higher, mortgage rates remain above 6%, and credit issuance is slowing as companies delay bond deals amid volatility and wider spreads. In the UK, a high share of inflation-linked government debt magnifies the fiscal impact of higher prices, while in the U.S., discussions about tools like yield curve control or agency mortgage bond purchases highlight how limited room there is to ease housing costs without a broader shift in Fed policy. From here, upcoming inflation releases and central bank communication will be decisive for the rates path. Near-term CPI and PCE prints may not yet fully capture the latest commodity surge, but if subsequent data confirm that oil and gas have reversed the disinflation trend, markets may lean further in a higher for longer, particularly in Europe and the UK. Conversely, any clear progress on reopening energy choke points or credible de-escalation in the Gulf could quickly ease rate hike pricing and shift focus back toward growth risks and the eventual timing of a broader easing cycle. The picture that emerges today is of an energy shock that has moved to the center of the macro narrative, pushing oil well above $100, lifting volatility, and forcing a rapid rethink of rate paths, especially in Europe and the UK. So long as flows through the Strait of Hormuz remain constrained and Iran stays hardline, the risk is that inflation stays elevated, growth expectations and earnings drift lower, and volatility remains a recurring feature rather than a brief scare. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.